So I'm Brian Klinksiek, Global Head of Research and Strategy for LaSalle. The Research and Strategy team is a 30-person group that is really focused on using data and analytics and frameworks to improve the risk-adjusted investment performance of our platform. The platform is a global real estate investment management firm, equity, debt, public and private on the equity side, and investing geographically with the global scope, developed markets in North America, Europe, and Asia Pacific. Probably the biggest new trend that we're seeing is just the foundation for the birth of a new real estate cycle. We have a pretty decisive turn in policy rates on the interest rate side. Long rates are still a little bit elevated and haven't gone down as much, but that's just reflective of markets pricing in a soft landing, so avoiding a recession. But what we do have is a lot more debt capital availability. We have return confidence to real estate markets, just more beginnings of signs of more transactions, better price discovery, more clarity on the markets, where the market's heading. And this is supporting what seems like it's going to be a much more active year for real estate in 2025, given this, the repricing from higher rates is that we're past that phase and we're moving to a new phase of interest rates remaining on the long rate side, high-ish for longer, but with a kind of clear direction towards improvement. That's probably the most important trend that I would highlight today, which is just the return of activity and confidence. So the global investment outlook for 2025 for real estate is a more upbeat one than it's been for several years. And in this context of greater investment activity, we see a really complicated investment menu. The post-COVID winning sectors of logistics and residential have some short-term issues in some markets, really due to oversupply, post-COVID demand normalization. So we see a real need to pick sectors and geographies that are less affected by that in the short term, or at least where those problems are priced in. We see the continued broadening of the investment menu through the emergence of niche and non-traditional sectors becoming more core-like. And we also see kind of sectors that had been out of favor from COVID really coming back into strength and investability. Retail is there already and highly investable, and it's actually posting some of the best performance of any property sector today. And office is at the beginnings of its recovery in the US, where it's been very beat up. So the outlook is really one of how do you pick from the many options on this complex investment menu. And it's taken us like a lot more time and pages to express our outlook than it has for a couple of years, just because there's a lot of bifurcation by quality, differentiation by location. And it really requires looking at the markets both with the right tempered optimism for the sort of dawn of a new real estate cycle, but a fine-tooth comb to find the right opportunities within that. So a new trend for 2025 is just the investability of the office sector. It's going from a very beat up market where select private investors are putting a bet on a recovery from very low entry prices, to one where systematically there appears to be value coming back into the market as the impact from work from home and hybrid working is more in the rearview mirror. And that sets up the stage for a recovery in demand. It'll take a while for fundamentals to get back into balance, but really monitoring office markets for true, attractive value is something that we're going to be doing more of in 2025, and I think the rest of the markets will as well. What we see ending is this wave of oversupply that's been impacting short-term fundamentals in global logistics and U.S. apartments. That wave of supply is coming to an end because the economics of development don't stack up without higher rents. And so while completions have been peaking recently, starts have fallen a lot. So it's a trick to find value in a market like that, because you need to underwrite the right amount of short-term softness and the right timing and magnitude of recovery off of that softness. But so it's sort of a two-part story. But that is, that wave of supply is now definitely in the rearview mirror in those most impacted sectors, and it's time to get to business to find, get down to business and find value within those markets. So, of course, the biggest macro topic for real estate is interest rates, and the path of economic growth. What we see is that long rates, despite the policy rates falling, long rates have remained a little bit higher. Some people have said that's because the election result in the US is going to lead to a lot more inflation. We just don't see that. We think that the election isn't really the proximate cause of that. There's a whole lot of reasons in terms of, the size of the majority in the Congress isn't enough to make big changes. Even some of the policies themselves, some of them point to more inflation, some of them point to less. We think it's just down to markets pricing in the fact that the economy is strong and won't fall off a cliff, and which is a good thing. But that also means that we won't see a huge decline or a quick decline in interest rates. So markets can still recover, and there are still recovering with a more stable but a kind of high-ish for longer interest rate environment, and that's a good thing. In terms of risks to that, macro topics that need to be monitored, is just a lot of other political risks out there that could drive some of the relativities between markets on a global basis. You have instability in governing coalitions in a bunch of major countries, Germany, France. The new government in the UK isn't all that popular. We've had events in South Korea recently. The longstanding political party in Japan called an election that they surprisingly lost. So this isn't just political transitions in the United States. This is pretty global, and there could be some unexpected consequences from that that could impact currencies and other important macro topics. The fundamental approach that we use for evaluating opportunities, both across geographies and between sectors and within sectors, is fair value. What is the return that you need to compensate you for the risk, and what is the expected return? And how do those two factors compare? And, it's not a magic black box that tells you buy this, sell that. And there's a whole lot of judgment that has to go into the decisions, the analysis that create both of those numbers. But it gives us a language for discussing and debating our views that can be expressed with numbers and can be compared across markets. And we've continued to develop and systematize and make more sophisticated with technology and the visualizations and to some extent using AI to improve our analysis in the realm of fair value and relative value. So that's the fundamental approach that we take on a top-down basis. Now, on a bottom-up basis, it's traditional real estate analysis. It's finding good opportunities, digging into the markets and submarkets, and getting familiar with the local nuances and the variation that might be exceptions to the big top-down story that we uncovered with fair value.